People Not Titles podcast, November 3rd. We have the Fed rate cut a quarter point. Was it enough? We think not. We have Zillow that has shown an amazing profitability in the face of all kinds of lawsuits and kerfluffle. And then we have the market stats for Chicago. We're coming right at you now. Well, hello, this is Steve Kaempf with the People Not Titles podcast. We have our November 3rd, 2025 edition of Market Trends. I'm here with my colleague, cohort, and good buddy, Matt Lombardi. Matt, welcome to the program again, another day.
Good morning, new month.
New month. Matt, we are in government shutdown day 34. Constant discussion about it. We're going to talk about what the Fed has done during this period of time. They cut the rates, Matt. Let's get into the details.
Yeah, and so last week we reported that the Fed was going to meet as part of the regular scheduled governance meetings.
Yes.
So that took place last week, and what came out of it, which was no shock to anybody, was a 0.25% cut in rates, which was the second rate cut this year.
Yes.
So mortgage rates really haven't moved. And in fact, they actually moved up very slightly.
Right, they say it was already built in.
It was built in.
A half a point would have moved the needle, Matt. A quarter point, not so sexy.
Exactly. So this rate cut was really based on the weakening labor market. And so Jerome Powell, when he speaks, everybody listens and markets move. But this quote, I think, really sums it up. So future cuts are not guaranteed, and Powell said a further reduction of the policy rate in December is not a foregone conclusion. In fact, far from it. Despite previous Fed, talking about cutting rates based on what the Fed is looking at, most people in the bettors market anticipated another rate cut in December. That is not a guarantee, and this quote pretty much says it. And after actually Powell said this quote, the markets went down a little bit. The stock markets went down a little bit.
Yeah, Matt, so the markets don't like it. This, to me, is a sign of Powell saying, I'm sticking with my guns. Too late, Powell. Too little, Powell. Whatever it is. He knows he has till about mid-year next year before he's out and the new person is in. And he's still being measured. You know, in one way, if he really believes it and wants to be principled, he's proving it here, Matt.
You got it. And, it's just continued pressure from Powell and others. I forget the gentleman's name who's new on the board. But we shall see what happens next year. And so, little note here, the economic backdrop of this meeting was, number one, the ongoing government shutdown, which lends no data for the Fed, as you have pointed out the last couple editions of our podcast. There's no official government data, so they're using outside data to make decisions. And what they're showing is, number one, inflation is continuing to rise, and hiring has pretty much slowed down. In the next story, we're going to talk more about this.
The job market.
And then it comes back to the possible stagflation, which is the three-headed monster of high inflation, slow or no economic growth, and then high or higher unemployment, which is what we don't want. And the Fed, their challenge is balancing the slowing employment and rising inflation, lowering risks to boost inflation, and raising rates risk a downturn.
Matt, I heard Pulte talking. He's the chair of the Department of Housing, right?
Oh, yeah.
And Pulte, who's the grandson of the original Pulte who founded it, and I believe that this Pulte, William, I believe it is the only one of 11 children of the Pulte hierarchy that actually got involved in the business. And he said, when they said, how much do you think Powell should cut rates? He didn't say a half point, a full point. He said 3 or 4 points. So him and Trump, I think that the rates should be down to 1 or 0, and it did get down to that point at one point. We saw what happened. So interesting. They're negotiating and they're raising the bar here, and Powell is here.
Right.
And so the battle continues.
And as we've discussed, and as you loyal viewers and listeners know, that the Fed is charged not just with interest rates.
Right, and not just obsessing about housing.
Right. I mean, that's a component of it, a huge component of it, but the labor markets, the inflation, and the monetary policy all culminate into their decision making. So a 0.25% rate cut, not bad, and we'll see in December.
I think the market, Matt, based on its response, expected a 0.5 point. Matt, let's talk about Powell. He had some interesting comments on AI, jobs, and kind of the balancing act of the Fed. What are the highlights there?
Yeah, I thought this was really interesting. So this was related to his remarks at the governor's meeting last week, which sort of piggybacked, all right, we're going to do this in October and December. We're going to see what happens. And this sort of shapes what he and the governors are looking at for the last meeting of 2025. So on paper, the labor markets look great. 4.3% unemployment, good consumer spending. But Powell says job creation is near zero, which means net new jobs and the layoffs have an equilibrium where you don't want that. You want new jobs being formed. And the catalyst for a lot of this is AI, and AI is reshaping hiring. CEOs are telling their investors they can do more with fewer workers. Layoffs and hiring freezes increasingly cite AI and automation. So AI investment, if you don't know, is booming.
Yes.
AI is everywhere. Every day you're going to hear something new about AI.
100%.
So that is happening.
Matt, if I may interject here.
You may.
So I know there was a lot of, I think it was Amazon, it was UPS, it was all these people that were announcing these cuts.
Yes.
Big swaths of people, and a lot of it was, they might be hiding behind AI, fire everybody. But what surprised me, I think that near zero, with the shift into AI and the efficiencies that are kicked in, might actually be a win. So I'm not trying to be political here. I'm just saying when you have the Industrial Revolution or any of these things, and you say, wow, this is a whole shift, everyone's losing their jobs. Well, if there's a whole new swath of different jobs out there, I think that's interesting to watch. And I remember a quote that we had some time ago, which was, if you are the robot in your job, plan on being replaced. But if you are managing, leading, strategizing the robotic nature of AI, you're going to have a role in this new marketplace.
Yeah, and I mean, what we're seeing here, jobs are being replaced.
Yes.
And CEOs are telling their investors, we're going to save money, which is good for our bottom line, which increases your shareholder value. I mean, it's happening, and that will shake out.
Absolutely. Corporate job cuts, you have it here, Matt.
Yep. So, and I thought this was important. This isn't like the dot-com bubble where there was all this fake money and inflated investments.
Bullshit companies, excuse my language.
Like, this is legit.
Yeah.
These AI companies have real earnings. Like, they're really making money. But moving forward, so the Fed's dilemma is AI is boosting output without hiring, strong GDP, soft jobs. Powell, one risk calls for lower rates, one calls for higher rates. Ooh. So that's the dilemma that they're pointing at. So the last, there's more in here that we'll cover, but no risk-free path for policy. The Fed is carefully navigating between inflation risks and weakening unemployment.
And they meet one more time this
weakening
year,
employment.
Yeah.
I'm sorry. Yes. And so you had said this, Amazon cut 14,000 jobs. And nearly 950,000 layoffs year to date, with most of those being tied to AI or automation related to AI. So yes, the great revolution is starting. I think it'll be the same next year, not to put on our, put the crystal ball out there, but this isn't going away.
Yeah.
AI is here to stay, and get with it. You've heard Steve and I talk about this a lot this past year. It's going to happen. And you can leverage the power of AI. Be the manager, be the leader of understanding and leveraging the AI, so you are not the robot being replaced by AI.
Absolutely, Matt. And I hearken back to our great interview with Faisal Hoke,
yes,
who we had, it's in our library of podcasts, but I'd go back and listen to that one about AI, about the nature of AI and how we can leverage it for the best.
Yep.
Okay, so, Matt, moving on. NAR mandatory membership lawsuit dismissed, but not over yet.
Yeah.
Let's talk about that.
So we've reported on numerous lawsuits against NAR. Specifically, these lawsuits that we're talking about now are against the membership structure. So the three-way membership structure, You become a realtor, you join your state association, your local association, as well as the National Association of Realtors.
The three-headed monster. again.
Three-headed monster, but also that allows you to access your local MLS because most of your local MLSs out there are owned by realtor organizations. So the requirement to access your MLS is realtor membership. There have been numerous lawsuits filed over the last 18 to 24 months by brokers and agents and companies out there. So this one that we're reporting on is a follow-up from Pennsylvania. So this was the federal appeal courts in the Third Circuit dismissed that NAR membership lawsuit, and this was filed by Maurice Muhammad, who I believe is a broker in Pennsylvania, and it was dismissed because Mr. Muhammad did not file his paperwork correctly.
So he'll be back, we have a feeling, Matt.
Correct. So he immediately asked the court to reinstate the appeal. He has not heard back from them, but that's where this case stands. This was originally filed a year ago, and the lawsuit alleged that requiring real estate agents to join NAR and access their local MLS violated antitrust laws and impacted minority real estate professionals.
So Matt, the big kerfluffle is they want access to the local MLS. They don't want to have to be a member of NAR. They're kind of forcing the NAR to say, hey, listen, we need more value than forced membership to access information that we're paying for already. And so the NAR has consistently struggled with articulating the value proposition of here's why you should be involved as a member. And so they're forcing folks to, and they haven't thought about it before, but now it's in the zeitgeist. Also, NAR, and once you're part of the NAR, you can actually use the term realtor, which is trademarked by them. And if you're a member of the NAR, you get to use that. If not, you don't get to use that. And right now, everyone has to be a member, so everyone uses realtor.
Correct. And so they estimate, the experts out there, that 3 out of 4 every licensee is a realtor. So about 75% of people who hold or have real estate licenses in the U.S. are members of National Association of Realtors or realtors.
Okay.
So as we mentioned, this isn't the only case. There's actually cases happening today in Texas, California, Georgia, Michigan, Louisiana, and Washington, D.C., and it's the same thing. All of these lawsuits in these different areas are about the three-way membership agreement.
Matt, my take is it just takes one of these to go the wrong way for the NAR, and the dam will break.
Yep.
So right now they're holding the line, but we're going to keep our eye on this one.
So NAR, they keep saying, they defend their policy as pro-competitive, saying unified membership supports ethics enforcement, advocacy, tools, and professional development. More to come, many lawsuits hanging out there. We will keep reporting because that's what we're here for.
That's what we do, Matt. Matt, Compass and Anywhere, we've reported on this big acquisition, the largest acquisition, which now has put about almost 40% of the brokers right under one roof. And so Compass has now come out and tried to, Reffkin, getting ahead of some things perhaps, is saying, hey, we're defining the relationships between the brands and everyone conglomerated. What are those details, Matt? Because I think they're interesting.
So Steve and I have been talking about, since Compass is taking over the real estate world and taking over Anywhere, which brands include Century 21, Coldwell Banker, ERA, Better Homes and Gardens, Sotheby's. So big legacy real estate brands. And so the speculation...
That have their own identity.
Have their own history,
Yes.
identity, footprint, nationally, but also in local municipalities, et cetera. Not unlike other legacy brands.
Absolutely.
So we speculate that Compass is going to engulf these brands and bring them into the Compass ecosystem, which means rebranding them as Compass, going to the corporate overlord of here's our technology platform, here's what we want you to do with private listings, et cetera.
So the Compass way, because it's the best way.
Exactly. I like that. The Compass way. They should trademark that.
But they're stepping away from that, Matt.
So yes, surprisingly, just last week, Robert Reffkin publicly said in Inman News, that's not what Compass is going to do. And we'll talk about what we think is going to happen. But he says all existing brands, company-owned and franchise, will continue operating independently. Franchise owners will retain full control of how they run their business. Tech choice and not mandated. Compass's tech platform, which they tout everywhere they can,
As one of their key differentiators, Matt.
will be offered but not required. Agents and brokers can choose the tools that best fit their business. Call me crazy, but that doesn't sound right to me. But we'll see. So data ownership respected. Agents can keep their client data and emails. Compass pledges never to contact agents' clients. Franchise owners can set their own data policies. You know, and there's no required use of the Compass private exclusives or their private listing network. Marketing decisions remain fully agent and seller driven. You know, and I'll summarize this with Reffkin emphasizes Compass's founding mission to empower agents. And I guess his mother was a real estate agent, single mother who raised him, and that's where he became visionary with the real estate industry.
I love it, Matt.
Steve, I want to hear some of your takes on Mr. Reffkin's future thoughts of what will happen with these legacy anywhere real estate
Well, Matt,
brands.
at first blush, I believe that there's a lot of efficiencies to be had to bring them all under one roof, and it doesn't look like that's going to be capitalized on in this instance if they're going to keep everyone siloed in their various different brands. I also think it's interesting, listing freedom maintained. So there is a debate on private listing and clear cooperation, and he's kind of saying, hey, we're not going to foist our very, very, very strong and adamant opinions about the private listing network and separate from clear cooperation on this. Matt, my guess is, and we'll get data for this, my guess is they've gotten sincere pushback. They're risking the loss of agents who are not, if they would have wanted to join Compass, they would have gotten a big check instead of the Anywhere getting the big check and them being left out in the cold. Okay, so they would have taken Compass out on their very aggressive, almost nonsensical buyouts of big agents. So since they didn't, this probably didn't land well. We have seen recruiting narratives here in Chicago. So my guess is there's going to be, or there is, an exodus of agents from this whole conglomerate, and they're trying to stem the tide of this and get ahead of it or respond to some of the things that were already happening.
Yep. We're going to put a pin in this and revisit what really happens.
That's why you have to subscribe to our, Matt, when the news comes, you want to be there as soon as it premieres. Hit that button, play, and listen to the glory.
Make it easy for yourself.
Make it easy
That's
for
right.
yourself.
Subscribe. But yeah, we're going to put a pin in this because I don't believe most of what is being said here. I think that at some point in time, these brands, it could be a year from now, it could be a little longer, but they will become part of the Compass ecosystem, branding, the platform they have created, this juggernaut. I don't think for a minute this is going to be the case. And you agents out there that are affected by this, you once again have a choice of where you want to be. Fit the brokerage or start your own brokerage of what makes the most sense for you and your clients.
Man, if you ever showed up to one of these timeshare presentations, the first thing they say is, we're not going to sell you anything. And then you literally need a Gatling gun to get out of there without buying some deal because it all sounds so good. So my guess is drop everyone's guard. You can remain the same. And then the constant wave of marketing is going to hit these people about the Compass way. The People Not Titles podcast is brought to you by Land Trust Title Services, your partners for results. Compass way, the Compass narrative, and it's a smart play in this sense. But anyway, Matt, we're going to move on from Compass and talk about most potential home buyers expect mortgage rates to drop. That's why they're waiting. And this goes back to one of our viewers talking about the coiled spring, Matt.
Yeah, so this is a housing market survey. I forget who did this, but it's an ongoing survey, and there's a lot of interesting points that Steve and I thought were good for you guys to hear. And so we're going to talk about that. So first, most would-be home buyers expect mortgage rates to keep declining, and many are waiting to buy because of it. So a lot of potential home buyers are sitting there. They're looking at mortgage rates, and they're saying, we are going to wait. We've talked about it, the psychological effect of mortgage rates, and at some point when they get 6.6% or lower, I think that's when the coil will be unleashed. Average 30-year rates are about 6.17, 6.2 as we speak today, which is the lowest in about a year. Agents are saying a rate drop expectations are causing buyers to sit on the sidelines and wait, which is what we don't want.
We don't want it,
And you
Matt.
buyers out there, don't wait.
Yeah, Matt, because, honestly, a quarter point here or there, to be frank, if that rate drops, you're going to have a whole another group of people selling that might be reflecting in the price going up, and now you've lost what you think you're going to save with rate with having to pay on the price.
You got it.
Matt, buyer behavior and challenges.
So majority of agents say the market currently favors buyers. So it is a buyer's market.
Mm-hmm.
We're seeing that not only here in Chicago, as well as Wisconsin, Midwest, but also nationwide. But affordability remains the top reason buyers are delaying their purchase.
Mm-hmm.
So they're holding out. They're waiting for mortgage rates to drop, but they're also waiting for prices to drop, which stubbornly they really have not. So top buyer concerns are mortgage rates, economic uncertainty, and the overall affordability of properties. Despite buyer worries, 44% of agents report prices falling in their markets, and only 20% are seeing prices rising.
Okay, so
rising.
it's kind of holding right there, it seems.
You got it. So some market dynamics, and this is the standoff, is sellers are still pricing like it's a seller's market. And buyers are waiting for rates and prices to drop. So that's where you're seeing in many areas this quote unquote standoff. You have unrealistic expectation of sellers who are listing their properties. I will talk about the house on my block, which I've talked about many issues now. Terry, my wife, just called me and said there's a big moving truck in front.
Something's happening.
It is not sold, they have rented.
Oh,
And
okay.
So we'll find out more about the rental rates, but this house is literally, I was looking, it was sold 2 years ago, remained vacant for 24 months, no income whatsoever, no rental, no buyers. They priced it way unrealistic expectations because these people rehabbed it. They probably should have went through Andrew Holmes' program to learn what they should have done.
Don't over-rehab.
They paid too much for the property, over-rehabbed, and then listed it at a price that is completely unrealistic, and now they are renting it. So anyway, that's just...
More to come on that, Matt.
So yes, so more market dynamics is the lock-in effect that we've talked about a lot, which is sellers are reluctant to move because the current mortgage rate they have is around 3% or less. And 89% of agents had at least one seller cut, sellers cut their price, with a third saying they're reducing their pricing as well. 40% of agents had sellers delist or delist, relist again, which we've talked about.
Yes.
The number of delistings is the highest point it's ever been because sellers are unrealistic of what they think they're going to get, and they have there's not an urgency for these sellers to move.
Matt and I will quote Andrew Holmes, the CEO of Chicago REIA, when he says, your profit is not made when you sell the home. The profit is made when you buy your home. In other words, the price you buy it at is the price you get it at, and you're going to have to live with it. Do not succumb to these people are reducing their prices or delisting. So hold the line, buyers, on your offers. Matt, inventory, regional trends.
Yep, so inventory and new listings are up versus last year, but it's still very tight. I mean, we've said this, it's a flat marketplace.
Yes.
And for affordable homes, there is such competition for affordable homes. We've talked about how 1 in 5 properties are being sold to real estate or purchased by real estate investors. And those are the lower priced affordable homes.
Absolutely.
Those are the ones where there's profit margin to be had.
Might even be off market, Matt.
Could be off market as well from a wholesaler. So they're out there, but if you're in an affordable home, that's where the prices will adjust. And price gains are slowing nationally. We'll talk about this, but the Northeast and Midwest have been good, and the South and Southwest and West have been bad. Outlook, most agents expect sales to hold steady or improve slightly next quarter and next year. About 17% expect sales to decline, and movement is happening mainly out of necessity moves, not for right
The 7 Ds, Matt.
Yep.
Matt.
Yes.
The NAR expects it to go up 14% next year. Let's put that in there. So with all this is going to decline, it's going to be flat. NAR is saying, and they're usually optimistic.
They're optimistic.
They're thinking we're at the bottom and that is going to go up. Matt, Zillow increased revenue and market dominance in Q3. This is impressive, especially with all of the news and fights that Zillow has been in, lawsuits and whatever. Matt, maybe this is what success looks like. It's just a dogfight to the top to scratch out your profits, and it seems to me like they're raking in the dough.
Yeah, this is a little snapshot into the corporate overlords of Zillow. For Q3, their CEO, Jeremy Waxman, Zillow is growing, and I think the biggest data point that shocked me and probably shocked you as well is Zillow's involvement. 80% of Q3 real estate transactions were part of the Zillow ecosystem. So you agents out there, you brokers out there, and you home buyers and sellers out there, which is not a surprise to Steve or I, 80% are using a Zillow product somewhere along the way that includes their Premier Agent, Follow-Up Boss, Showing Time, Showcase, and Dot Loop.
Man, it's like stepping on a hill of red ants. They just crawl all the way up your leg, and it's hard to get rid of each and every one of them. And Zillow seems to have his tentacles in every single aspect of things, so much so that on the mortgage, on the listing, on the lead, on the buy, on the whatever, they seem to have their fingers into the pot.
And here's some more numbers for you for Q3. User base, 250 million average monthly unique users, which is 7% up year over year. 2.5 billion with a B. Site visits in Q3, which is 4%.
That's almost as much as the People Not Titles podcast site. Man.
If they're lucky, they
yeah.
And their revenue, $676 million, which is 16% up year over year. $10 million in profit, which reverses last year's $20 million loss at the same time. Key revenue drivers: rental division, 41% up year over year. Mortgage division, 36% up year over year. And they monetize all this stuff: agent tools, lead generation, rentals, and the mortgage arm.
Man, it's interesting that the rentals, so they've hedged themselves in the market. Hey, you don't want to buy, you don't want to sell, we'll get you on the rental side of things. And so they literally have both sides of the market cornered in that way.
And what Zillow did from day one, which also differentiated themselves, especially from Realtor.com, because Realtor.com was the industry website.
Yes.
So News Corp owns them now. So the Murdoch family
Conglomerate
owns Realtor.com, but they have a licensing operating agreement with NAR, to use the term realtor. But part of that is no FSBOs. No for sale by owners were ever shown on Realtor.com, where Zillow, which is not realtor based, they exactly bring it all on.
Bring it on. We'll
bring
take
your
it all.
rentals, bring your for sale by owners.
Right.
Bring your BS,
tired and hungry.
Your BS estimate.
Yep.
Everybody come on board. So that was the difference, and they really grew, hit the marketplace running, and that is why they are succeeding where others, like Realtor.com, are fine, but not at this level.
Man, I'm impressed that they can walk and chew gum at the same time, in the sense of they can protect themselves with all the lawsuits. We have Kaempf, Homebuyers, CoStar, FTC, Attorney Generals, competitor claims. CoStar said you stole our pictures. On and on we go. And they're just like, we have our defense team. You know, it's defense, offense, and special teams, Matt. And they got it.
They got it. So Zillow just keeps on growing, the juggernaut. We'll see what happens year end, but positive sign for them.
Yeah, good for them, Matt. Chicago housing market, Matt, shout out. We are not negative about Chicago. We are all positive.
Right.
Okay? And Chicago housing market cooling, but still affordable.
So we'll talk some high points here. None of this should be shocking to any agents, brokers dealing in the Chicago marketplace. And even home buyers and sellers, you may be surprised that some of these numbers pan out. But number one, home price appreciation is slowing a little bit. The median price in the city of Chicago was $360,000, which is just under 4% year over year, but the slowest pace in about 2 years. In the metro area, also up around $360,000, about 3% year over year, well below last year's rate of just under 8%. So still appreciating, but not at the hot pace that it was before.
Matt, and I'm going to state the obvious here. You know, there's been a lot of talk of this kind of younger generation saying, oh, but I can get a better rate of return in stocks. Well, let's just remember, when you're investing in stocks, you are putting a whole sum of money in, and then you're waiting on that return. Here, we're talking about 3% on the full value of your home. Even if you borrow 10 grand to get it, plus you got to weigh out your mortgage thing and whatnot, but that's 3 or 4% on the entire swath of the value of the property.
Yep.
Okay, Matt, the gap is narrowing in the national market.
Yeah, so price appreciation in the Chicago area is outpacing the rest of the U.S., about 3.6% versus 2% nationally, but that's shrinking a little bit. August was still strong. Case-Shiller index showed about 6% price growth in Chicago, nearly 4 times the national rate of 1.5%. We've talked about this a little bit, so this is just continuing. Second strongest price growth among 20 major metro areas. Only New York was higher, but things are going to slow down a little bit, especially year-end.
Yep, as we head into the fall, people are going to start
head into it.
Yep.
But we've said this before, and I'm going to repeat it, that we are slow and steady with our price appreciation. When you look at charts and graphs of the Midwest, or Chicago specifically, compared to other parts of the country, we're slow and steady. Where others, boom, 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 boom. Arizona, Florida, Nevada, Texas.
Yes, and slow and steady relates to affordability, man.
100%.
Yes.
I'm glad you said that. So it's one of the most affordable places to live. For those of you in the Chicago area, you may not think it is, but it really is.
Yeah, you look at Atlanta, 37% up. LA, 115. Miami, 142%. So Chicago is still a great place. We're big fans, man.
Yep. Chicago home prices have risen just 5% in real terms since 2000. So for the past 26 years, it's not much growth, and it's the lowest among most metro areas. So Chicago is still an affordable place. And like you said, we are pro-Chicago.
Pro-Chicago, Matt.
Even when you throw in bad budgeting, pension payments,
taxes,
new
insurance.
taxes. Oh, by the way, state tax, they're
I know, in the
not
secret
bailing
squirrel
out the
overnight meeting.
RTA and CTA. They needed a big infusion of cash. So unfortunately, we're going to pay 45 cents per toll higher across the board. So sorry, you guys driving on the tollways.
Yep.
Go on, Steve.
Let's go to sales, Matt. They're still a little sluggish in Chicago.
Flat.
Metro sales up only 1%. City sales flat.
Flat.
Yeah, city sales, I thought it was interesting. Just 5 more closings. That's how close the game is to 2024. If you feel like you're living 2024 again, it's because you are.
It's flat. And, once again, pro-Chicago. But are you in Cook County?
No.
So our real estate taxes, they were supposed to be paid August, September. This is like the 3rd or 4th year in a row. Still haven't paid them yet because of system issues, other stuff.
Well, hopefully that system never comes back up and running. You have to pay them at all, Matt.
They're going to get you. They're going to get you one way or another. All right,
Matt, let's go. Let's shift to perhaps the biggest news in the NFL.
So the Bears pulled out this unbelievable win yesterday that put me on an emotional roller coaster. I'm glad
you're still recovering, Matt.
I am still recovering. I'm at a certain age where you can't have that heart rate going up and down so quickly. And I'm just so happy they won, because if they would have lost that game to the Bengals yesterday, my week would have been ruined.
Yeah, shout out to Joe Flacco, still doing it at 40, Matt. But it wasn't enough to beat Caleb Williams. And the most exciting play was that big tight end, Colston Loveland, getting that ball, smacking through those 2 defenders, and making his way to the end zone for the victory.
It's very exciting.
Yeah.
So the Bears, I believe, have a better record than the Chiefs right now.
Yes.
Who lost to the Bills.
And we're equal with the Packers.
Yeah, I think the Packers
are a slight,
because they have a tie in there.
Oh, they have a tie in
so
there.
they're in first place, and then Detroit.
Okay. Well, we got another week to wait.
Yeah, so the Bears have more victories at this point than I ever thought they would. So apologies to anybody.
Yeah. No, fantastic. And Matt, we have a couple of big events coming up.
Yeah, so this week on, what's today? Thursday.
Yeah.
We have our Chicago Loop CLE.
Yep.
There's still seats. Any attorneys out there that need 2 hours of credit. We have that for you. If you just want to hang out with us, Steve and I will be
meet
there.
Meet the team.
Yeah, it's going to
be
be
the celebrities of Market Trends, man.
Yeah, so Market Trends will be signing autographs.
Yes.
Maybe we'll get you on a podcast if you show up.
Yep.
So you never know. But that's the big thing for this week. Just exciting football. Love the football season.
Excellent.
And the fall. And the time change. So hopefully you turn your clocks back.
Absolutely. You were up at 3 in the morning.
I was up at 4 a.m.
Matt was sitting here at 3 in the morning saying, hey, when are we recording? Okay, this is the People Not Titles podcast for November 3rd, signing off. We'll see you next week. Hey, thanks for listening to the People Not Titles podcast. We are proudly sponsored by Land Trust Title Services. If you enjoyed the podcast, please hit the like button, please subscribe, and we'd love it if you'd share our podcast with your friends. Thanks a lot.